what's up, everybody? Another week, another Ask Me Anything happy hour. We are here. We have some pre-submitted questions, so get your questions ready. Make sure they're difficult. Make sure they're on point for what you want, because the whole team's here and we're ready to answer your questions.
All right, we got one pre-submitted question. It seems pretty easy. So it's from Angela Salisbury. She says, should I require a personal guarantee when lending if it's a first position and there is 72% equity in the property?
It depends. I mean, I would say I would always ask for a personal guarantee. Why? Well, because just like a bank, I've never taken a loan out from a bank that they haven't asked me for a personal guarantee. And well, I never made too big of a gruff about it, you know. So I think if you're in a position where you can get first position and a personal guarantee, that just strengthens everything. So you want to be in the best position possible. I mean, that's what you should do. Yes.
Jimmy Davidson said, in Nashville, I wanted to ask Clay from One America what One America's balance sheet looks like and where he sees concerns. Any thoughts?
It's funny. Stephen and I have seen that balance sheet. They did it. I don't remember what meeting that was at, Stephen. Was it Santa Barbara or somewhere?
Santa Barbara.
Santa Barbara. They showed us like a pie chart of every asset that they owned. So when I looked at the assets and I looked at where I would see potential risk, it was very minimal. I mean, they had very little, less than New York Life. I remember seeing New York Life's numbers, and I think back in the day they had like 6 or 8% in equities, and it was heavily weighted by Pfizer. So I'm sure New York Life did quite well with that back in the day. And One America was even less from an equity standpoint. They don't have a lot of risky assets on them. Tons of treasury bonds, lots of loans. Policy loans were very low. Do you remember what else they had on there, Stephen? A lot of real estate. They own a lot of real estate.
2% was policy loans.
Yeah, 2.6 policy loans. Look at that piece, Joe. You got some balloons.
I was trying to see if I got a picture.
You had about, I think they have about, was 100, however much in commercial. They do have a lot of commercial. There was like $120 million portion of that piece, and they had 0 delinquencies. That was one of the things that really stood out to me. They have big properties like Home Depots and things like that, right? So.
And parking lots. I know, like in Indianapolis, you know, I remember talking to them when they were giving me the tour. They own a bunch of parking lots in Indianapolis. So
they're the ones making me pay for parking. Damn it! I hate
yeah. There's no free lunch out there.
Get your questions in, guys.
We actually got a lot of questions, so we'll move as fast as we can to.
Right, it's a $16 billion portfolio, kind of broken down where that stuff's spread out. I don't know if you want to share that, or how about I just text you this, Jimmy?
Yeah, I think that would be good. But I mean, most of the mutually owned companies are going to be very similar for how they're allocated. I mean, some more to one versus another. I mean, different risk tolerances, but for the most part, they're extremely conservative and very, very well diversified portfolios that the insurance companies have.
And Jimmy, one of the coolest things they talked about, the first thing, and the thing that really, really stood out for me as the first thing the guy who's in charge of all their different investments said was, we don't outsource our thinking. Now, we might look similar to other mutually owned companies. We talk about it with these other leaders, but we're not outsourcing our thinking to anyone else. And I love that when you're talking about a $30 billion portfolio, you know, so.
Okay. David and Dorothy Shearer. Hi, David and Dorothy. They say, can we open a policy using our Roth?
If you're over 15 and a half, I mean, why couldn't you? You could take money from the policy, money from the Roth. You could take and then use the distributions, which are tax-free, to put into a tax-free policy. That would be a solid strategy, because you're increasing death benefit. There's definitely a cause and a need there for that. So yeah, that would work great.
It's the Chaos Crew. Says, hi, my name is Sharina. I'm asking for my sister. Would it be a good time to purchase a home for first-time home buyers? I've been watching Chris's videos and gave her the knowledge on the 6 to 8 months. And then she also wants to know how to get in contact with the master of.
That's better than Mr. HELOC.
Yeah, don't give him that title, the master of HELOC.
The master.
I like that.
I'll take a stab at this. I don't think there's ever a bad time to purchase your home, especially a first-time home, because they have so many good incentives. I mean, housing pricing is very high right now. I mean, that's the only factor. And is pricing going to come down in the future? More than likely. I mean, how much? Who knows? But it'll definitely come off of these highs. But it's your house, so listen. If you stay in the house 10 years, you're probably okay.
Yeah.
Yeah.
Okay. Casual Credit Gaming says, how do you guys feel about when you build an IBC style policy to concurrently get a long dated convertible term to max human life value, or at least close? That way you have a proper death benefit.
I mean, the question is going to be why. I mean, what's the purpose of the death benefit? I wouldn't get a death benefit just for the sake of having a death benefit. For me, there has to be a purpose for it. Is it for, a mortgage, for debts, for generational wealth, all that kind of stuff? So, I mean, yes and no. It just depends on what your reasoning is for it and what you're going to use it for.
Isn't the convertible term maximum conversion up to 500K? Isn't that right? I think I'm 95% sure that it's up to 500K. So depending, I mean, I don't know if that gets you to your max human life value in trying to convert that. I'm not sure I fully understand the question.
Well, I do. It's simple. He's just saying, he wants to build an IBC policy, but also, let's just say, and I don't know, casual credit gaming, probably young, healthy, thinking, hey, I'm in my peak health right now in my life. So, this would be a time to max out my current human life value and get some convertible term. I could use the protection for my family. So the term will be really cheap to do that. And down the line, as I want, I can just convert this term into, IBC policies. I don't disagree with that. I mean,
yeah.
If the goal is the death benefit, that's a great strategy to do.
Yeah, and with North America, it's up to 1 million.
I took out another term policy. It's not issued yet, but actually my medical's tomorrow for it. I got to remember that. But yeah.
I mean, there's stipulations for it. I mean, it's up to, with One America, I think it's up to 1 million. I'm looking at their thing right now. But yeah, 1 million in term insurance for whole life can be converted over.
Which isn't a lot. That's not going to get you a long way. I mean, so you want to read the rules for the insurance company to see how much, like Brian was saying, they'll allow you to convert. Because if they'll only allow you to convert $1 million of $10 million of coverage, then you definitely don't want to do it for the conversion, because $1 million death benefit's not going to give you a whole lot of room to get creative with building, a big, robust IBC policy.
Yeah.
What about like for getting, like, let's say, because he said like you're doing an IBC policy and getting convertible term at the same time. Is that because of, that health exam or anything like that, or getting?
I don't know. I'm thinking the big thought process, which you would agree with, is they want to max out the human life value where they're at today, which will increase over time, but they want to max it out and get convertible terms so that they don't ever have a time where the insurance company says, hey, you can't get coverage because of X, Y, and Z. They've already got the coverage. They convert. So I think the biggest question there is just, can you get an insurance company that will take that much term and allow it all to be converted? And like Brian said, probably not. But you could check, or we could check.
And also just keep in mind, I mean, just because a policy is convertible is not a guarantee that it will convert. There's a whole list of requirements that you have to meet to do it. So
yeah, they make it sound good, and it's a little bit more expensive than regular term. It generally will work fine.
All right, and then Drew Hitchcock just chimed in saying Nashville replays are uploading as we speak.
Nice.
Thank you, Drew.
And then as far as the master of HELOC, I put his email in the chat. So joseph@chrisnoggle.com.
Thank you.
You're welcome.
Everybody send me an email.
You need a T-shirt. This is Master of HELOC.
I like it.
Okay.
You should get it behind your wall too, in big neon letters.
Neon letters. Remember we saw the police station in Nashville was the only police station like on earth that probably has bright neon lights.
By the way, everybody, what she's talking about, last weekend we all spent time together in Nashville, Tennessee, going through a 2-day IBC course, and it was awesome. Great hanging out with everybody there, and a lot of you in the chat, Jamie and you too, I see you just chimed in. We were all there together. So next time we have an event, you guys all need to be there because it was fantastic.
I'm still amazed though that we did the IBC mastermind in Nash. Everything said Nash on it, like Nelson Nash. The whole reason we're there is because of Nelson Nash. I thought it was so perfect. We didn't really play with that much, but
Should have.
All right, let's keep going with the questions.
Yep. So Michael Deckard is saying, I'm about to get funding for my invention. How do I set up the process to borrow from ourselves using the 250 mil for bringing that device to market?
Yeah, so you got capital funding coming in. I mean, I don't know if it's an investment bank, venture capital, or where the 250 is coming from, but I would just make sure that in whatever docs you have with them, they don't have specific places that money can be held. Most would never have a problem with the policy because it's guaranteed. So it'd kind of be like tier 1 funding. That'd be step number 1. Step number 2 would really just be sitting down and devising the proper structure for what it is you're trying to accomplish. I mean, if you're bringing a product to market, that's easy. I mean, development, having those things, using the policy to fund those things, and then taking the rev from the product, rolling it back in. I mean, that would absolutely work. Just make sure it's in line with what the source of the 250 million, wants to be done. But I don't know as if we'd be able to. I can tell you right now, you wouldn't be able to get all of that into one company. We could probably go to several companies. So you'd right out of the hole, you'd be one of the rare ones that, we would have to literally use multiple insurance companies to place that much of a chunk of money. And it's just the insurance companies just don't want to be on the hook for that much. Because remember, with that much money, that's a crazy death benefit. So I don't even know if you'd be able to place all of it, but definitely could probably do a huge chunk. Just it would require many companies. But
Interesting.
we definitely know how to do that. So if you just booked a call, we'll have somebody put a link up, and then Craig and I can kind of get involved, because that would be more advanced planning, and then strategize the best way to do what it is you're trying to do. But the first step would be a call with one of the team members to figure out exactly what your needs and goals are, what you're trying to accomplish, and then we can build a structure around it.
And then Christopher says, hey, first time live chat. So definitely keep bugging us, because everybody does week after week. I applied for a HELOC and they wanted a reason for the loan. I told them that I was planning on paying off my mortgage. Should I tell them I want to use some to start a policy?
No, just tell them. The less info you give the bank, the better. So, they want to know what you're using the loan for. Just be like, well, I was thinking, I don't know, just you should make something stupid up, but just tell them you want to pay off debt. That always works just fine, because they can rationalize that.
Wild.
Yeah, don't even say I want to pay off my mortgage. Just say I want to pay off debt.
Jimmy Davidson said, found out this weekend that First Savings Bank is not doing HELOCs on commercial properties or rentals yet.
Correct. It's in the works. They've been.
Are they getting there, Joe?
Yeah, they're getting there. They've been working on it. Couple, red tape things that they have to figure out, but they're working on it.
Okay, and then this was kind of like a callback to that question we were talking about earlier about an IBC policy and convertible debt. So Casual Credit Gaming is saying the purpose is that an IBC policy doesn't have nearly enough death benefit in the relatively short term, say under 10 years, to protect my family if something happened. I don't know.
So,
Makes sense.
Yeah, that's the reason to get term right there.
Well, you usually,
Listen, I took a wild guess at that. I got pretty close.
yeah, or just do a dump in and add the term into the policy, and then you got a huge death benefit the first 10 years.
Zircon is saying at graduation of policyholder, does beneficiaries get cash value plus death benefits?
I thought you just casually Zircon.
Okay, so now we can pull in Mr. Dave Ramsey. So the policy contract states that you get face value, but the illustration, an in-force illustration and your statements will show the true value of the death benefit, because there's the face plus the paid up additions, which is increasing the death benefit. So you're always going to get the face value plus the effect of any increase in the death benefit through paid up additions. So it's going to be more than the face value. It's not death benefit plus cash value, but the cash value increases the death benefit. So if you were to look at an illustration, you'll see how the death benefit goes up.
Tim is saying if someone is older and has health issues, can they still get a policy?
And health issues is kind of broad. When you think,
It depends.
yeah,
It depends. If you bring what the issues are, we can always go to preliminary underwriting and ask, like, directly. The more information we have, the better that we can help assist someone that's looking to get insured.
Can you guys name like a few health maybe issues that people have had, like of your clients that that they got approved, but they had XYZ?
Type 2 diabetes, that's a really common one. If you're not on insulin and your diabetes is within the normal ranges with the medication, you're usually fine for a policy standard.
What do they want? What is AC1 or A1C?
A1C.
Below 7?
Under 7.
Usually the cutoff.
Yeah.
So Tim did say, like it is diabetes. Can you get a policy with
if it's
diabetes?
insulin, it's no go.
Correct.
If it's just controlled with diet and medication, you got a chance. If you could show history, like that you've maintained, a pretty good A1C, then yeah, but insulin is a no.
Okay.
And what about and cholesterol and diabetes or high blood pressure are the other two main ones? But if they're within normal ranges, normal height to weight, and with medication, you're fine too usually.
Okay. And Jimmy Davidson is saying, Gabe, have you set up a key man policy on your jiu-jitsu business? And if so, how are you handling the premium deposits?
Before I answer this one, I have a couple older gentlemen, ones in in their 50s. They've been able to get off of diabetes medications from training jiu-jitsu. So if you want to get in shape, find a jiu-jitsu place near you and go train. It's a fun way to stay in shape. But no, I have two policies. I just set one up. I did a big dump in. It does have a term. So, but that one's basically the one I'm going to be using for my business. But it's in my name, and I'm going to be loaning from, my policy from my personal name to my business, and then using that to move the money. But everything is just, it's been from savings. And the way I like this, the way I want to structure it too, because again, it'll take us 20 years or so to be able to practice this correctly. You just got to start figure out where you are and start adapting it to you. But I want to think of it as, first my savings. So everything after my expenses are paid, goes to savings. I want to be able to get that into my policies. Then also my profits. So if I have like a sale of a building or dividends from the painting business or profits from the jiu-jitsu, I want to then also put that into my into a policy. And then eventually I want to be able to get all my revenue in so that all the revenue comes in, and then I can pay all my expenses, business expenses and personal expenses with my policies. But right now everything's still in my personal name. I don't have anything with the school, but my goal is to loan the money from my, pay yourself first, then loan to my business, and then recycle and recapture all the money that leaves my business, that leaves my family, investing in getting more customers. That way, it continues to grow. But I hope that answered the question.
Before we move on real fast, Chris, we were talking about Monopoly earlier. So I was pulling it up just to kind of look at the board and guess, what they're doing now, the most latest game of Monopoly. And I feel like this is like predictive programming, trying to get us ready for the future. But look at this. They don't have cash anymore. It's purely electronic. Look at this. You use a bank card now. So you see that?
Oh no!
So it's completely cashless Monopoly. No more cash. So I feel like
the cash was the only reason to play the freaking game.
I know. Like part of the
programming.
Isn't that wild though? Look at that.
What a shame.
The only reason I ever wanted to play Monopoly was to hold the money.
Okay. What a shame.
Programming us, man, getting us ready.
Wow.
CBDB coming soon.
I need a version that has guns and ammo as the currency.
All right. Antonio Rodriguez is saying, when you were approved for a policy, if your health rating was not as good, if your health has improved, can we ask for a reevaluation? If they find it to be negative, will they call in the policy? This is a question that we actually had at the event too. Remember we were talking about changing the...
And yeah, you certainly can. I mean, once a year you can do this. I've had tremendous success doing this with people, that were smokers and they quit smoking. People that had high blood pressure, they went on a diet, got their diet in order, and a year later they come back and get select preferred. I've seen that a bunch of times. So going from a standard smoker rating to a select preferred would definitely help your number.
And then I know that One America was asked, if you do that and then if you it's negative, does that negatively impact it? And I know that he said no, but that was just One America.
They're not going to decrease your rating, right? For having.
Oh no, they can't contractually. They can't do anything to your current policy.
They can improve it.
Back and you went through the new medical and they found cancer and you're like, oh, I didn't know I had that. They can't cancel you and be like, oh man, they're on it. It just takes 2 years. So that's the only risk within the first 2 years is the contestability period. If they found out you lied about something, then maybe that would open Pandora's box, but it's just the first 2 years and then that's gone.
Okay. And then Jimmy Davidson said, after Mike Sammett's talk on long-term care, what are your thoughts on obtaining one versus adding the LT care rider to a policy? And what's the difference, I guess, between getting long-term care and just adding a rider?
It's a good question. It's such a drastic difference between the asset care plan, like the standalone asset care policy that takes care of long-term care versus a long-term care rider that's added to a whole life. If you do the research, the asset care it's so far above the long-term care rider benefits you would get in a whole life with the rider on it, that if you just look at both side by side, you'd never even look at the riders. You would never. The riders are sort of just they're just seasoning on top of the policy. They're just trying to make it more attractive. It's really, I'm not saying it's a bad option to do the long-term care rider, but it's not all that it's cracked up to be. The asset care policy, all that it's cracked up to be for sure.
Interesting. Okay. It's the Chaos Crew said, going back to Gabe, I want to clarify, you are insured on the policy and the use of funds is for your business to fund a policy and to pay yourself. I apologize if I misunderstood. So you are insured on the policy and you use the funds of your business to fund your policy and to pay yourself.
Well, the idea is I'll use the money from the policy I put into the business, and then I can use that for marketing or to pay for my business expenses to attract the customers. Then money comes in from the customers, and I can use that to pay my salary. But the money is just flowing the same way a business would be running. I don't know if that makes sense, but yeah.
Do you do a capital contribution? Do you lend it to the business? Does the business pay you back interest?
Yeah, I have it set up so that I pay myself back interest. So I'm doing it at 15%. I figured that's a good amount. Because I've had to use credit cards and lines of credit, so that's my plan now. I just got my policy in force 2 weeks ago. I have about 86,000 in loans I can take out. I'm going to use that to pay off the lines of credit that I had left because I wanted to start to use this policy. It just took me a long time to be able to get the money to do the dump in. So I wanted to do the timing. But yeah, I want to structure it so the business will repay back at 15%.
Okay. And then Jimmy Davidson is chiming in saying loans, no capital contributions. Okay. So Brian Young saying, what design of whole life would you recommend for your kids?
The ones I've designed, I did two different ones. The one is 60% base, 40% PUA. The other, I think I flipped it, is 60% PUA, 40% base.
Yeah, Brian, it depends. It depends on a lot of things, but like Chris said, that 40 or 50 or 60% going to the base makes sense because that's where the real growth of the policy is over time. And then some of the limiters are you can only insure the kids typically up to about $1 million or half of what the parents are insured for. So like Connor's is a 60-40 with 40 to the base because if I flip that, I wouldn't have been able to contribute as much over the years. And like I have his PUAs going out to year 15 or year 20 since I started it when he was pretty young. So you're looking for that longer term growth with the kids policies.
Cool. And then Antonio is saying, do we contact your team for the physical request or the insurance company?
Our team.
Yeah, definitely.
We'll handle everything for you, Antonio. So there's a whole application involved. We can go to the preliminary underwriters. We have a great relationship with the carriers. We can decide, depending on your situation, like which insurance company might be the best one to go with. Some seem to do better with health issues than others. And so we'll assist you with all that. I'll put the link one more time. With us.
Yeah. And to clarify, we're going to help you with the whole thing, start to finish. Get the policy that includes the health exam and that everything thereafter.
True that.
Tim Bates is saying, do you have anything in your classes that can help someone like me to get better control of my money? Tim, what's your money problem? What are you doing?
Yeah, that's
the more
it.
you learn, the more you're going to get control. So, yeah.
Yeah, read Nelson's book, Becoming Your Own Banker. Start there because it might be some of the human problems, right, that you're looking to overcome and change those habits. Whatever you're doing now, like Shauna said, what is the problem? What's the outcome you're trying to reach? And then we can start giving some feedback on that loop. So
Julius is saying, hi guys, what do I need to understand? Nelson Nash invented a concept called infinite banking that is only valid in USA and Canada.
True.
Yeah, basically, yes.
He didn't invent a thing that's only available in US and Canada. It just happens that US and Canada are the only two places where you can actually get a specially designed whole life. Now, I think the Dominican Republic, of all places, if I'm not mistaken, I saw a policy designed properly from Dominican. So I'm not saying there's not a chance. It's just that's the reason.
Ironically, I got an email today too. I think that can someone in the UK do this? So
yeah, I look at the UK over and over.
Yeah.
So all they have is term. It's their government. Different countries. It's your government. It's not the insurance company. It's the government.
That's interesting. They only have term insurance over there.
Yeah, like New Zealand's only term.
That's
It might have
very
variations
interesting.
of permanent insurance, but they're all like universal life derivatives of term.
Okay, Antonio saying, sorry, I probably missed it. If I'm contributing monthly to the PUA, should I pay off loans first or premium?
Max the PUAs out first,
Yeah.
but don't steal from your bank.
Yeah, it depends.
Okay.
It really, that's the right answer. It depends, but usually 9 out of 10, it's going to be max the PUA out first. But again, everybody, thanks for catching that, Carson. This scenario could be different.
Yeah, and one thing we actually talked pretty in depth on that today on Wealth Webinar, and we kind of went through like all the different pieces of a policy, like all the different, how the money flows and how you should put it back in, and all the different concepts like that. So it's pretty good. So definitely check that out if you missed it today live.
Okay, and then Antonio just chimed in again that he has policies with our team already. So I think he means with just like, does he reach out to us or the insurance company when it comes to wanting that change in your health rating, like as he got healthier?
The implementation specialist would be who you would reach out to. So you can go to themoneymultiplier.com and you can log in and you can see who your I-team is.
Here's just a little statement. Jimmy Davidson saying, Joe, just like Carson and his dad have a podcast, Generational Gains, I feel like you and Ariana should have something along the same lines to follow her financial path in life.
That would be cool.
Do it.
Cool.
Awesome.
The next generation
There you go.
goes right along with your, what were you? Master of HELOC.
Yep.
Every time I hear that, I think of the cartoon as that we were kids, right? Of He-Man, right? Or
Masters of the Universe.
yes, that's it. Carson would not know what we're talking about.
Nope.
And by the way, Connor's doing a brain gig of reading Becoming Your Own Banker. I'm hoping that he gets through it faster than someone on our team. So
That'd be great.
I have a bet. I have a bet who's going to finish it first, Connor or someone else I know. I don't know.
And where did he get a copy of that book? Thank you very much.
We'll ship one.
That was super awesome.
You're welcome.
He's super because of what Chris wrote in it and what Brent wrote in it. Connor's like, "Where's my copy of it?" So super awesome. Thank you, Chris. I mean, and thank you, Steven. But I do have that bet that I think he's going to finish the book before you do, Steven. So.
I agree with
I want a piece of this action.
You guys are silly.
Okay, so Christopher was the one talking earlier about how he's getting a HELOC and is going to pay off his mortgage. He's saying, I have a commitment letter, and one of the steps is that I must provide them with a 30-day payoff letter to my mortgage company. Should I abort mission or ask them to remove that?
Oh, goodness gracious. Why the hell do they care? Joe, why the heck would they care?
Is he getting a second? You know what? Because of DTI. Maybe his number.
Oh,
I think he's getting a second lien to pay off the
Dirty
why is he doing that? We might need a call, Christopher.
Yeah, I think you two should definitely talk for a couple of minutes.
Yeah, if you're trying to get a second lien by using your equity to pay off the mortgage, you're kind of doing it backwards. We need to go in and take a full line. They pay off the mortgage, your credit cards, do a debt consolidation. Yeah, I don't know what you got going on, but it sounds to me as though DTI and your numbers are being involved here.
Yeah, definitely get on a call. I don't even want to answer any more of that because like that doesn't sound good.
Yeah.
There's an easy fix for it. It might not be at that bank, but
Well, don't forget too, they just might want to be double dipping and get more money from them.
that could be.
There's a question from before this one from Brian saying 401k loans to help pay off debt faster. Is that a good idea?
I mean, it all depends on your situation.
Yeah, it's a great idea if it's structured properly.
Yeah.
I've done I think 3 or 4 YouTube videos on that exact topic showing like how it would work.
Well, at the end of the day, it just goes back to like,
50%.
yeah, you got to pay off debt before investing. You can make even if you're making 15, 20% in the markets on a 401k, which you're not, but let's just say you were, and your credit card debt's at 23, 25, 27%, you're losing money,
Yep.
Take that loan, pay off.
I think one of the big mistakes people make is they hear half of the story, right? It's like the circle with the infinite banking concept. They see half of it and they're like, oh, that's cool. And then they forget the other half, which is the part that they need to be more responsible about, which is the recapture, recycle. So if you were to do that, Brian, if you were to take a loan from your 401k, let's say it's 50 grand, you took the 50 grand, you paid off all your debts. You would absolutely have to figure out how much were all those debts that you were paying that you now don't have to pay. And I would take every penny of that, not a penny less. And I would redirect all of that back to pay off the 401k. And then when the 401k is paid back, just that's extra income that you now have to save. That's how I would do it. But I mean, don't be in a rush to pay the loan to the 401k off, but just mentally, that's the easiest way. Money goes out, pays off debts, debt payments come back to the 401k with the source of where the money starts. Wouldn't take long.
Same as using a policy loan for that
Same.
same situation. Same thing.
You just don't earn uninterrupted compounding interest in the 401k like you do the policy. But you're paying yourself back with interest, which is kind of better than the policy, because the policy, you're paying interest to the insurance company. The 401k, you're paying interest back to yourself. But then you're not getting the compounding. So yeah, they're just, plus the 401k, you can only do 50,000 or 50%. So
The concept, though, of you just moving the money was what I was making the point that Chris teaches so greatly, right? He just does the circle around and just move the money around, and you're not freeing up free money to go buy something new. You're using that to pay yourself back.
Exactly.
People get excited when they free up money. They want to go buy stuff.
I know.
And it's the same thing with student loans. If you were paying, or not student loans, sorry, tuition for kids. I was talking to somebody today who was like, hey, I want to take loans from my policy to pay for my kids' tuition for the next 4 years, and I don't want to pay myself back. Is that possible? And it's like, well, if you are saving up $1,000 a month for the past 10 years to take your kid to school, just keep doing that. Don't stop saving $1,000 a month. Keep saving $1,000 a month. Just now redirect it to save it in the policy. So it's not a loan you're repaying. I mean, I guess it is, but I look at it as you're just redirecting all of your funds to go towards the policy versus elsewhere. And so you can do that exact same model with taxes or a car or in investments, whatever. But we want to make sure the money is closed in that circle, in that loop. It keeps going around.
Brian said it might be just a first lien HELOC at 7.63% that he's trying to pay off. So that would be, you could just make the same payment that you're making to the HELOC, right? Back to the 401k?
Yeah.
Yeah.
Yeah, but you're not just making, you're not recapturing 7.63. You're recapturing 7.63 plus the interest that the provider charges on the loan, but all that interest goes back into your account. It's actually pretty heck of a good return.
If the HELOC's more than $50,000 though, then he only can chunk down the HELOC and not fully pay it off. So you have to probably do that a few times before he can really get the HELOC gone and then fully pay himself back.
Jimmy Davidson saying, I have a problem with don't steal the peas. If I owned a grocery store, our family's food needs would finally become tax deductible. Bad banker.
Tax deductible loss, right? Yeah.
What's the best, it's just Dad says, what's the best 10-year snapshot, so to speak, of where someone was 10 years ago and 10 years later, where they are, like a before and after, probably in regards to IBC, someone like a Craig or anybody?
So many, I wouldn't even know where to start. I mean,
We should, this is a good question though. What we should do is we should have maybe a video or like a brochure of like, this is a person's financial situation, their exact numbers today, and this is the exact numbers 10 years later. We should have something like that to pull out. That'd be great.
It would.
I like that idea. It'd take a serious undertaking to get it all to work, but yeah, that's pretty awesome.
Yeah, tell us where you were 10 years ago, Joe. You're on the railroad?
Yeah, I was still on the railroad. Didn't even meet Chris yet.
Nope.
People ask me this question though, and they're like, well, what's it going to look like in 5 years? It's like, well, your cash value, the total cumulative cash value will probably be about equal to your cumulative premium paid in. So in all reality, your savings, you could call it, is about equal in a few years. So you're not going to see a huge benefit if that's what you're looking at. But maybe you would have financed different vehicles, paid yourself back, and practiced things you would otherwise not have practiced, or recaptured interest you would have otherwise paid to somebody else and paid back to yourself that you wouldn't see in just a policy. You would see from being the bank and doing these things. And that's why it's just Dad. It's a great name, by the way. We haven't done something like that because it'd be very difficult to try and track that. Like all the financial things and activities you did inside of a policy for 10 years, it would be, you'd have to check monthly bank statements for 10 years to understand exactly what happened everywhere to be able to track something like that. So a short answer, I would say, is 10 years down the line, you're going to understand how banking works and you're going to have a family bank. You're going to be able to finance anything for your kids or grandkids or friends through a system that you control and you compound in. And so that's just the underlying basis of what the product of whole life can be for you if you use it for banking the way we teach. But that would be a really short answer.
After 5 years, the policy would be efficient. Absolutely. 90% of the time.
Yeah.
A couple people You could check with like Craig. Craig could share where he was 10 years ago, right, with banking and why he started because of what he thought about qualified plans. Same with Chris, same with Brent. I mean, there are people on our team who have been practicing for 10 plus years. I can tell you just in a short 3-year period, I went from having $100,000+ of bad debt to having no bad debt, right? To financing trips through my son's policy and just starting the investment journey right now. Right. So we're all at different points. It's just that, by the way, awesome. I love the name too, but it's really going to be maybe bigger snapshots of the building, keeping and creating more wealth. And then talking about some of the emotional changes that go through too. I had someone walk up to me at the 3-day and was just like, he was so like, Chris, you met him. Everyone probably here met him. He was so excited about the journey and like being there with everybody and meeting everyone in person. And just tell me how he felt. And I just told him right in that moment, I'm like, brother, remember what that feels like. I challenge you to go sit down and write down that feeling because you're going to go back by yourself. People are going to tell you it doesn't work. You're going to get scared again. Fear is going to pop up. But if you can anchor into that feeling, and he called me the next day as I was driving back home and he's like, Jason, the feeling was relief. So it's also that portion of the journey too. It takes you from like scarcity to abundance as far as your money mindset goes.
Well, something that's not part of the policy is that event that we just went to. Like, so that's just a benefit. Like you can get a whole life insurance policy and it could impact you where you weren't traveling places to meet people and to expand what you know about money and how you're doing things, but now you are. And where could that take you? So the policy sometimes has like outside benefits where it might make you get on a plane and go to Nashville and see all of us.
I want to hit a question over here on Instagram because it's the first real question we've had come up. The rest of it is just banter. Cashflow Kendley said, if you over contribute the amount to the policy, do you start a new policy every time you get a huge lump sum of money? Anyone want to take that? I feel like I'm answering too many questions.
Read it one more time, if you would.
So basically they're just saying if they over contribute to the policy, what would be the best option? If they had the money and they wanted to dump it all in the policy, but the policy is going to max, should they start a new policy every time they get a lump sum of money?
Yeah, that's what I've got about 3 clients doing it right now. They've done 3 or 4 policies. They have one that's mainly more heavy on the premium side with a nominal dump-in. Then future policies are more smaller premiums, larger dump-ins because they have big cash events. Every time they have a cash event, it's real estate, by the way, new policy, small premium, etc. So that's what they're doing.
Why not? Why not?
I think the only factor of that is, a lot of people get big bonuses, right? They get quarterly bonuses and, those bonuses aren't carved in stone. So the only thing to be considered is if you're going to do lump sums like that, and every time you start a new policy, just realize there's a premium deposit you have to make to keep that thing built the proper way so that it doesn't in the future run into issues. So don't just look at lump sums as like every lump sum is a new policy. I would look at lump sums plus cash flow or new cash flow that's generated from your banking system. Is that enough to support that next policy with the dump-in? That's another factor.
Amen. That was my first thought was exactly that, Chris. Like you got to think about your cash flow. Is that something that's consistent? Are you getting dump-ins? You got to think about the premium deposit every year. I'm going through that right now with a client who started a policy to test it, was going to pay off a debt, totaled a car, and now he's like, Jason, I want to finance this new car, but I don't have enough cash flow. I'm like, well, you can start another policy. You told me that you were testing this, or you can go put a down payment on the car, basically finance the car and then build up the policy and pay it off within a period of time. But there's not another way to do it. Like you either have to have the premium deposits every year if you're putting in that lump sum. So it's like a long-term approach, right? So as long as we're long-term thinking about, it's a great time to open a new policy.
Got a couple more questions here. So Julius is saying, hi guys, do you recommend a construction so that international clients can apply for a policy in US or Canada by any means, like for instance, a business opening in those countries?
You recommend a construction.
I looked back because I saw hey, please answer my question. I felt bad. So probably like Shauna, and I scrolled up and I read this and I didn't understand.
Yeah. Well, regardless, I think one of the things that you have to have is don't you have to have a social security number like from the US?
No, you have to have an ITIN number, so an individual taxpayer identification number, which is the same as a social, but it's for non-citizens. So you have to have a green card. There's different requirements, but you have to have a human person in the U.S. or a body that's insurable. And that can be an ITIN number, a green card, work visa, things like that. They all have different stipulations. Just having a business here in the U.S. isn't going to necessarily allow you to do infinite banking. And I've dealt with this probably about a couple dozen times here recently, and it's challenging. So you have to have a person here in the U.S. first off, and then if you're doing business here and you travel here though with a green card, you can do it. But there's a lot of hoops to jump through, to be honest. There's a lot of hoops to jump through, and it oftentimes does not make sense unless it's a high income, high revenue situation. So, but I mean, bottom line is, you can always hop on a call with us to go through it.
Brent is saying, I really enjoyed how Brent finances his children's stuff and how how he can loan, how they can loan to him. Sorry. I'd love to get more details on how he does that, any way that can happen. So he's talking about Brent Kessler over the weekend.
Just charge your family, pay them 10% if they're giving you money and you're investing it and making a bigger spread on the money, or charge them like I think 12 or 14% on anything they're buying, so that money stays in the family brand. I love it too. Like, I think that's a super cool thing that Brent's doing, because he's really not giving the family any breaks. He's helping them learn how to bank, and that's a really good lesson. So,
yep.
I actually tell people that on the phone all the time, because I hear people all the time like, talk to this one lady, like an older school teacher, just getting by, and her daughter was like a doctor, and she had the woman's other home, and she was paying her like less than the going rate for for whatever the rent was. And I was like, you got to raise her rent. She's like, I can't do that. It's my daughter. I'm like, she's a doctor and she's living there almost for free. Like, you have to charge her what the going rate is. Otherwise you'll continue not to have any money. It kind of made me mad. And that's what, when I share what Brent's doing, I like that he's approaching it from a spread banking standpoint. So
here's a question for you. You're going to buy $100,000 piece of equipment. They offer 0% financing. Do you use your policy to buy it, or do you use the 0% financing?
Good question.
I would almost do the financing and then go take the money in the policy and go put it to work for you into a cash flowing asset
to pay it.
I do what I've been doing with my HELOC. I've used the OPM, put that into an investment, have the investment come back, give me interest, use the interest to pay off the loan.
Okay, it's just Dad. So we only have a couple more minutes, but we have a few questions. So it's just Dad said, so right term now for conversion later, as any potential MEC approaches for original policy to avoid uninsurability, correct?
Yeah.
And convert the term into a new 40/60 policy.
Well, I can't say is the case. Definitely the first part of that question, like term, that's smart. Yeah. And then later get on a call with us when you're ready to convert, and then we can build the designs that fit the problem.
Okay. And then one more question is also, are there any companies that shy away from having multiple of these type of policies?
Not necessarily. Mass Mutual, wouldn't allow you to take a loan in the first year, so you'd need to use a CV line of credit. But outside of that, there's no companies that would shy away from you having many of these policies.
They don't look at the amount of policies as they look at the total death benefit of all of the policies. Right. So, you can max yourself out with one policy and they're not going to give you any more, or you could have 10 with room to go and get more, so it just depends on the death benefit.
Interesting. And shout out to Damian Robinson. He said, I got a new person in here today. His name is Lamont. So thanks, Damian, for bringing someone else like Campfire.
Thanks for joining us, Lamont.
I love that. Damian. Let's have a contest. Like, can we give away some stuff for the person that brings the most people during the month of November or something like that? Like, let's start bringing friends that need to learn about this and incentivize people.
Yeah, you're gonna send them some Founding Father shirts.
Sure, I gotta make them still. Yeah,
I like it.
I like the logo. I'll put the eagle on there. It's cool. Right?
Then he's also asking, are we still doing the forklift deal?
I literally just got the payout today or yesterday on my forklift that just sold. So
the big one?
It wasn't a huge one, but it was like a $42,000 one. Yeah, I made like, I can't remember, $4,600.
It's a pretty big one.
You see what he said?
Damian's got a whole ship for us. He says he's out on the ship.
That's great.
And then, as always, the way to get on any of our calendars is mentors.beyourownbanker.com.
There it is.
Yeah. So I guess it is kind of a big one. I forgot how big that one was.
Beast, man.
Yeah.
I mean, Chris, you're 6'5", so yeah, thing's huge. Look at this.
I know. I make that thing look a little dwarf. With that being said, folks, thanks for joining us for another week, another Ask Me Anything happy hour. Glad you joined us. Thanks for inviting people. Make sure you tell more folks about it. Bring them along, drag them along, pull their hair, whatever it is. Get them on the next one. Until then, see you next time.